In the last video, we talked about sequence, how markets don't reprice all at once and they move layer by layer. Gold moved first, silver followed, and stress began to surface. Today, I want to explain why gold moved first. Not because inflation surprised, not because of geopolitics, and also not because of short-term demand. Gold moved because the global bond market lost its last anchor. That anchor was Japan. For decades, Japan played a very specific role in the global system. Japanese interest rates were held extremely low, and that did two things. First, it allowed Japanese capital to flow outward into the US bonds, global equities, and risk assets. Second, it quietly suppressed global yields even when other central banks were tightening. As long as Japanese yields stayed pinned, the system could absorb the stress. Bond volatility stayed contained, currency markets stayed orderly, and confidence in long-term money held together. Japan's role was foundational. That's what is changing now. Recently, long-term Japanese interest rates started rising because investors became less comfortable lending money for long periods of time. In simple terms, they wanted to be paid more for uncertainty about the future. At the same time, the yen weakened sharply. USD JPY moved into levels that triggered official concern, not casual talk, but actual rate checks and warnings about intervention. And that matters because it tells us this wasn't just currency trading. It was a loss of confidence showing up in two places at once, in bonds and in the currency. And when long-term lending and currency stability weaken together, something fundamental in the system shifts. And this is where gold comes in. Gold does not respond to growth. It does not respond to industrial demand. And it does not wait for inflation to show up in consumer prices. Gold responds when confidence in long-term promises weakens. Rising bond volatility, unstable currencies, uncertainty about future purchasing power. That's gold's signal. This is why gold moved before silver exploded and before energy became obvious and before headlines caught up. This was the monetary trust layer moving first. Notice what hasn't happened yet. There is no recession signal here. There's no collapse or a crisis narrative. And that's the whole point. Structural shifts don't announce themselves loudly. They start quietly in the plumbing. First in bonds, then in currencies, then in gold. Only later do they reach leverage, commodities, and daily life. That's why gold rises first. This also explains something important about what comes next. When gold moves for these reasons, it doesn't mean everything breaks tomorrow. It means the system is adjusting its foundations. Silver's role, as we discussed before, is to confirm and amplify that signal. Energy's role is different. It enforces costs later under resistance. But none of this happens in a straight line. It happens through volatility, through testing, and through pressure being shifted from one layer to another. So if you're watching markets right now and thinking, why does this feel unsettled even without a crisis? This is why. The last anchor that held global yields down is slipping quietly. And when anchors move, pricing has to adjust. And that's what is shown in gold today. If you like this video, don't forget to like, share, and subscribe. You're watching MarketVelugu, Light on Markets. See you in another interesting episode.